And the Fed looks like it's on the move, ready to reverse policy. Danny Kirsch joins us, head of options at Piper Sandler. Danny, great to have you here this afternoon. A few things in the session today, but are they all too backward looking?
Yeah, I have a hard time getting too excited about some of the data we got today. Just thinking out loud, first of all, we're in the end of August. Volumes this week, at least on the equity side, are 30% below normal. You had VIX expiry today, which always is some sort of an event. And it's interesting because volatility, implied volatility, has actually been going up the past 2 days. I think some of that is there's been huge hedges were bought yesterday. Some of it is August VIX options rolled off, so people need to add protection. I also think it's just liquidity is very light right now, and it seems like the path of least resistance for now is higher. And it's like you don't short a dull market. You got I get this revisions from first quarter of this year where, yeah, I mean, job market is weak as we expected, but the unemployment rate already reflected that. Unemployment has been ticking up, and this just confirmed why the unemployment rate has been ticking up. The job growth has been much less than what we've seen. And I guess the market is interpreting this and the minutes as the Jackson Hole speech being very dovish from Powell, which I think it's going to be hard for him to meet expectations to be as dovish as what the market is currently pricing in. Look at the 10-year, for instance. The 10-year now is below 4. And even if, let's say, they're cutting 800 bips, does that make sense to you that the 10-year's still going to rally even more at that low rate? And I think that's what the market is keying on, this very low 10-year rate. And that's sort of helping with Qs. That's helping with Russell. And, the 2 years flattish, you have the curve flattening again. It just seems like I think a lot of this is just mispositioning. You still have this delta decay on all the hedging that took place and the covering that took place a few weeks ago. And the market is sort of keying off that. And I think one very popular trade that is being unwound is a 210 steepener. That has to be the case based on the fact that 10 years rallying more than 2 years. Does that make any sense to you?
Yeah. Well, it's interesting, Danny, because it seems like we've had this kind of maturation of the market, which was looking at good data, seeing stocks rally, basically since our employment report driven sell-off, yen sell-off, whatever you want to call it. We've had yields up, stocks up on some really important days. We had good data being well received by stocks. So I thought we were kind of growing out of like the root for lower yields, lower dollar thing, but I guess maybe we're not.
Yeah, it seems like today it's lower yields driven by Fed statements, Fed jawboning, that the market seems to like. Because again, getting like rallying on data from 3 months ago is kind of insane, or 5 months ago is a little bit insane. But I think that's what the 10-year sort of keying on. But I do think that the 10-year rally, though, is a positioning thing. And I wonder if Jackson Hole will be a market clearing event where you actually start to see, no matter what he says, rates, especially in the long end, start to back up as these shorts where people, I think, had the right trade. I think the steepener is probably the right trade in a cutting environment, get fully stopped out. And then you start to see the market act a little more normal amidst higher volume. But again, there's really just a dearth of events after Jackson Hole. You've got NVIDIA, the end of August, and then and then you have Labor Day. So I think I think it's like the adage, you do not short a dull market. You don't fight the trend when there's no volume. But when it comes to September, I expect that to change. I expect volatility to pick up, and the markets perhaps, as more data comes out, I think the market could be challenged.
Okay. As far as the move in volatility, as an options guy, Danny, what does the landscape look to you like now that the dust has settled from that record-breaking vol spike in collapse, that swing? Really unlike anything we've ever seen. So what do we do with VIX? I also noticed today VIX has been up with stocks up.
I think options are look incredibly cheap. Just like think about this. Over the last 10 days, we've rallied around 8%. Over the next month, the S&P is pricing in a 3% move. Over the next month, we have Jackson Hole, we have NVIDIA, we have an ISM, we have payrolls, we have BOJ, FOMC, CPI. We have a ton of macro events coming over the next month. People getting back into the office, wanting to reposition, re-put on trades. So to me, it's like 1 month options are incredibly cheap in the S&P. It makes sense to me that the VIX should be going up, even with the market flattish, or and it went up yesterday on a little bit of a down move. But I think that speaks to we are realizing a ton, we're moving a ton, and options should be reflecting that higher implied volatility, higher realized volatility. And I think, perhaps on Monday And last week, a little volatility was a little bit oversold, and that's that fear of not monetizing your hedge. And I think we saw some of that last week and a little bit on Monday. And now maybe people are sort of getting back into their seats, like, oh, VIX is 16 from 60
Right.
a week and a half ago. There's
Yeah.
a ton of macro events, and we're moving a ton, and the market's going to be at new highs maybe in a day or two. Maybe not the worst idea to take advantage of this rally and buy a put here or there. And that's what this chart is showing. It's showing the rolling cost of a 1 month 95, 97 half put spread. I think that's roughly like a SPX September 5,500, 54 or 5350 put spread, somewhere in that range. And it's 29 basis points to make 2.5%. So it's roughly a 10-to-1 payout. Optionality is cheap. You have a ton of macro events, and I agree with you. I thought it was good, as bad as bad. Maybe that's not the case now with no like volumes, but that I think will be the case. And the fact that we get all of these data points will matter. And I'd rather be hedged and take advantage of the fact that, like, oh, well, like if you missed hedging on the last sell-off, like cool, you get to do it now. Markets at a higher level, volatility is kind of back to where it was, and you're getting a ton of bites at the apple with all these catalysts.
I really like the point that, a 16 VIX, compared to a 12 might seem expensive, but compared to a 60, probably tells you that maybe we're a little bit complacent in this juncture. The other thing, too, is with the market kind of on edge about the economy, I mean, even something as simple as like jobless claims on a weekly basis seems like they have potential to spike vol. It's not even like you have to have massive mega events. It seems like pretty much every major employment data point now has the ability to move the market.
I totally agree. And something to keep in mind. So in this volatility, like blow up, we went from 60 to below 15 in 7 trading days. That's by far the fastest ever. During COVID, it took 474 trading days. When XIV blew up, it took 30 days. When the yuan was devalued, that took 56 days. And in those shorter instances, the XIV and yuan, you had us retest the lows within 2 months. So you had like the huge vol recovery, and then we retested the low a few months after that. We could be into a similar sort of instance. And our policy team has said this: the market doesn't really start to care about the election until September. September is only 2 weeks away, and I think you have one candidate who recently said they want to raise corporate taxes 28%. Who depending on what poll you look like, could be winning. It could be 50-50. It doesn't really matter. Market didn't really care at all about that comment. These comments, these bullets will start to matter in September, October, and I think that potentially is why the VIX is firm. Options are getting a tad more expensive. Again, I think you hit the nail on the head. Yeah, they're 10 more expensive than a 12 VIX, but a 16 VIX isn't high in the scheme of how much we've moved over the last month. And the market is letting you hedge for a very cheap cost. Like, take advantage of it. And if you want to get longer, great. Puts are cheap. Buy some stocks.
All right. Hey, Danny, real quick, we got about 60 seconds. I know you're looking at the China trade as well, something you've dabbled in here and there. What do you see? What's the opportunity?
Well, between now and actually August 30th, 50% of the KWeb reports earnings. You saw yesterday, Walmart sold their stake in JD. Stock was down. They sold $5 billion. I think it was $3.5 billion worth of the stock. Stock was down, but that overhang had been sitting there. That overhang's gone. KWeb has underperformed the FXI. It's obviously massively underperformed Qs. If you see some money sort of re-engage, and Walmart's saying the reason they're dumping their JD stake is because they want to enter China. They want to do it themselves. Maybe that overhangs over. Volatility in KWeb is extremely cheap. You have the earnings catalyst, and you don't have really much macro data. And then one other point to make is that US dollar has been weakening a ton as of late, and that allows China to stimulate without blowing up the CNY. So you have this like potential for China to stimulate, taking advantage of the fact that the dollar has been weakening the last month, on top of the fact volatility low and a ton of earnings. I like KWeb for a trade for the next month. Cheap upside. Again, you get the earnings, and maybe see a little bit of catch up.
All right. Good stuff. Like it. Little catch up trade within the China complex, and some cheap looking put spreads from here for the next month. Thank you, Danny Kirsch.
Thank you.